Once again, my name is Patrick Jankowski. I am the Senior Vice President of Research at the Greater Houston Partnership, and I'll be sharing some insights with you today about the COVID-19 virus, WTI, and the impact on Houston's economy. Just a little base work to start with. We have just shy of 2 million cases globally. That was as of midnight, April 14th. You're obviously watching this on Wednesday or Thursday, or even later than that, so the cases are obviously higher than that. About 120,000 deaths worldwide. If you want to look at the number of confirmed cases in the US, once again, this was as of midnight, April 14th, just shy of 600,000 and just shy of 20,000 deaths. You can see the slope of the line there. You can see how rapidly the COVID-19 has taken off in the US. Just a handful of cases, fewer than 100 cases on March 22nd. And then you can see where we are now, close to 600,000 as of today. And once again, this is another one, just to kind of put it in perspective for you. You can look to the far right-hand side. You can see the state of Texas, just shy of 14,000 cases. And then you can see where New York is, 189,000 cases. Texas has actually fared well compared to a lot of the other states in dealing with the COVID-19 virus. A little bit of chronology here, show you just how fast everything happened. First case was diagnosed in the US on January 1st. Went almost a month, but then March 4th, we had the first case in Houston. It was just 3 weeks after that the stay-at-home order was issued for Harris County. April 2nd, 1 million cases worldwide, and the death toll in the U.S. approached 20,000 on April 11th. Give you some idea, you can see the slope of the line, or you can see the rate at which cases have increased in Metro Houston. Right now, as of this broadcast, we were just shy of 6,000 cases in Houston. I'm sure by the time you see this, the news gets out, we'll probably be over 6,000 cases in Houston. So the COVID-19 it's had a global impact. It's had an impact in the US. It's had an impact on Houston. It's had an impact on oil prices. I'm going to talk to you about each one of those, give you some insights. Let's start with the global impact. This came from Bloomberg. International Monetary Fund says great lockdown. The recession likely worse since the Depression. And it's interesting because we used to refer to this as, you've heard of the Great Depression, 0809 was referred to the Great Recession. And now I'm starting to hear this referred to as the Great Lockdown, because that's pretty much what we are in. We're not seeing an impact from a financial collapse, at least not yet. The impact that we're all seeing is because everyone is trying to stay home, social distance, and not get out in public. This was just released this morning, which is the morning of April 14th. The IMF, they're looking at the global economy, GDP to shrink by about 3%. They actually expect to see some growth in India, some growth in China, maybe some of the other Asian countries. They actually expect to see a contraction in the US, a contraction in Europe, contraction in parts of Africa. And that's what's going to be pulling down global GDP. 3%, that's actually quite large if you look at where we were in 2009. When you put together a forecast, you have economists, that's what they call as a risk to the forecast. In essence, it's a risk, what could you have gotten wrong, or what are the risks that the forecast should be revised upward or downward. You can actually have an upward risk to the forecast, events which happen, which make things turn out to be better than you thought they would be, or downside risks, which make things worse than you actually thought they would be. We're actually looking at more downside risks with the IMF forecast. They're concerned that there might be a second wave of the pandemic, that the policy measures put in place won't be strong enough to counteract the pandemic, that there'll be social distancing will go a lot longer than people thought it would, business and consumer confidence doesn't return. You can look there, you look at the deep global recession, you can look at the IMF, this is the chart that they published today, showing you their forecast. You can see growth was pretty steady from about 2011 up until last year, and you can see that drop on the right-hand side where we were in 2020, and then the pickup that you see on the right-hand side. So we're hoping that we'll see, for whatever contraction we see this year, that we'll start to see some growth next year. Actually, I say we're hoping, it's what the IMF, the International Monetary Fund, is looking at. IMF has also put together a map showing you where they expect the growth to be and where they expect a contraction to be. Now, the darker the red on the map is, the more severe the contraction. And you can see most of the world won't have as severe a contraction as say, the Baltic states or Italy will have. The lighter pinker areas are areas that are performing a little bit better, and the blue areas are areas where actually expect to see some growth. But you can definitely see that as you look across the world, just geographically, there are more pink and more red than there is blue, a sign just what we're going to see global GDP contracting by 3%. This is a little different. This is IHS Markit. They put together a PMI, also referred to a Purchasing Manufacturers Index. They actually look at about 89 different countries across the world. They ask a series of questions, crunch the numbers, quite similar to the way we crunch numbers putting together the Houston PMI. I'm looking at orders, looking at employment, looking at sales, looking at backlogs. Whenever the number is above 50, that's a sign the economy is expanding and will continue to expand. Whenever it's below 50, that's a sign of contraction. What you're looking at here are the 10 largest export markets for the US. Actually, 8 of Houston's largest export markets are contained in these 10. And you can see that the largest export markets for the US, only 2 of them are projected to be growing right now and growing for the next few months. And that's the Netherlands and China. But all these other ones, Brazil, the UK, Mexico, Canada, and so forth, are contracting. And that doesn't bode well for Houston, since so much of our economy is built on global trade. We had a study done by Brookings Institute a while back. It estimated about 20% of our GDP in Houston is tied to exports. If you add imports to that, it probably gets up closer to 30%. The last time I ran the numbers, we were looking at about 450,000 jobs in Houston that are tied to global trade. We have over 5,000 companies in Houston doing business globally. So you can see any slowdown in the global economy is going to have a pretty serious impact on Houston's economy. World Trade Organization, it put out a press release about a week ago that trade is set to plunge as the COVID-19 pandemic upends the global economy. This is the chart that they put out that accompanied their press release. A lot of lines there, it might be a little bit confusing. That blue line that kind of sweeps up to the right, the top blue line, that was the trend global trade was on from 1990 to 2008. That yellow line is if you took the trend just from 2011 to 2018. But what's important is the green line and the red line, and it shows you how far trade will be falling off trend. The green line is kind of an optimistic scenario that it only falls by about 10, 12, 13%. The red line shows a fairly significant drop, almost as much as 30%. Oh, I hit the wrong button. Sorry, guys. And if you just have those who are listening, if you just wait for me one moment, I'm going to get back up to where I was. And please have patience with me. Okay, we're back to where we were. That's just a momentary glitch. We're looking at a trade slump right here. You can see the IMF, where they show trade is actually declining. You can see they're forecasting a dip as well. Let's talk about the US economy, the impact of the COVID virus on the US. You can see Federal Chairman Jerome Powell said there's nothing fundamentally wrong with the economy. Yeah, that's true. There's nothing fundamentally wrong. What's wrong with the economy, with the problem, the challenges are dealing with the social distancing and the responses people are having because of the pandemic. This is a survey that McKinsey and Company put together. They asked respondents in the US, am I cutting back on my spending? And you can see that over 50% strongly agree with the cutting back. They're cutting back their spending. And that's affecting consumer confidence and it's affecting business confidence. If you want to look at adjustments to routines, you know, that question's in the lower right-hand corner. How long do you believe you need to adjust your routines given the current COVID-19 situation before things return back to normal? And you can see over half of the respondents are thinking it's going to take over 4 months to over a year before things get back to normal. And you can kind of look at the bar on the bottom and the bar on the top. The bar on the bottom represents how people felt. Middle of March, that's back just when COVID-19 was just beginning to take its hold on the US. And the top bar reflects where we were just last week. And you can see how people are somewhat, I don't know if I'd say pessimistic, but they're a little bit more concerned that it's going to take longer to respond. So this is a survey the Wall Street Journal publishes. They publish it the first business day of the month every month. It's a survey of economists across the US. Ask them a series of questions. One of the things they ask is what is their forecast of GDP? If you read across that bottom line, you can actually see the names of some of the economists that participated in the forecast. You can look in some of them you'll probably recognize and ask them, basically what is going to happen to US GDP in the second quarter. The average is 25.3% contraction. I mean, most of the economists, the average of the economists was that the economy was going to contract by about a fourth. There are some that said it's actually going to contract by 50%, which is pretty severe. There is actually one, I guess, rascal or rapscallion, and who actually forecasted GDP to grow in the second quarter. I don't see how that's going to happen, so I actually didn't even put that in the chart right there. You've got Robert Kaplan, who's the Federal Reserve Bank president, and he talked about that we should expect a severe economic contraction in the second quarter. Some of the data that he's looking at is a survey that the Federal Reserve Bank of Dallas puts together. You can see the number of respondents in the manufacturing part of the survey, and they asked them about new orders and utilization of their capacity and production. And you can see the survey was based in March compared to February. And you can see over half of the firms said that they've seen a decrease in new orders. Over 40% said their capacity is being less utilized now than it was in February. You see production, almost half of them said their production has gone down. The Dallas Fed does another survey of the service sector, asks a similar number of questions. They asked about hours worked. Almost half the firms have cut the hours worked in their firms. About a fourth of them have reduced employment. You can see 70% are actually experiencing revenue losses. So you can see it seems to be actually hitting maybe some of the services side a little bit harder if you look at revenue and hours worked. And so this is a concern. This is one of the reasons why Robert Kaplan is really worried about there being a steep recession in the second quarter of the year. Let's look at unemployment. Houston Business Journal, a headline, Texas unemployment claims continue their upward trajectory. The initial claims for unemployment insurance, we started seeing the layoff started around the middle of the month, so we started seeing a spike in claims for the week ending March 21st. This is Texas claims, and you can look at them. And you add those 3 months together, you're close to about 750, 780,000 initial claims for unemployment insurance. And we're probably going to see, we still have to see April 7th, April 11th, April 18th, and so forth. I expect we're going to probably see initial claims continue on at a similar rate, at least for the next few months. Not the next few months, the next few weeks. These are initial claims for unemployment insurance in Houston, the metropolitan area. This is for the 8-county area. And once again, you see the yellow is the number of claims that were filed that week a year ago, and the purple is the number of claims that were filed that week this year. And you can see how claims have significantly shot up. You add all those numbers together, March 21st, March 28th, April 4th, you're at over 180,000 initial claims for unemployment insurance, when in a normal period would have maybe 10,000. So you can see over 170,000 people in just a 3-week period have filed for unemployment insurance. I really expect that number will get up to 250,000 easily by the time we're done with this. Wouldn't be surprised if it gets up close to 300,000. Expected changes in employment. Once again, this is the Federal Reserve Bank of Dallas survey. Ask them and the overall both services and manufacturing what they expect to happen. You can see that they're expecting over half of them are expecting employment to decrease this year compared to last year. Only about 41%, about 2 in 5, expect it to remain the same. If you expect slight increases, but the overall preponderance of respondents show that people expect employment to finish up the year lower than it finished up last year. So Channel 13 ran a story. It's the perfect storm, grim outlook for Houston's economy. Now I'm going to go ahead and talk about the impact of the COVID-19 virus on Houston's economy. This is the Purchasing Managers Index. This is the local PMI. This is somewhat analogous to the PMI, which we had for the global economies when I showed you the 10 leading trading partners. That red line is real significant because they ask a series of questions. The purchasing managers, they take their responses, mash all the numbers together, come up with an index. Whenever that blue line is above the red line, that's a sign Houston's economy is expanding and will continue to expand. Whenever it falls below that red line, that's a sign of contraction. So you go all the way to the far left, you see where 09 is. That's the Great Recession. That's when the PMI fell to 39.0. You can look through 15 and 16. That was a fracking bust. And you can see how weak the economy was there. You see there's a little bit of dip between 17 and 18. That was Hurricane Harvey. But look where we are right around where 2020 is. Look at the downturn there. PMI came in at 40.2. We are almost as low as we were during the worst part of the Great Recession. Definitely a sign that we're seeing a contraction in the local economy, and we probably will for the next month or two. Chemicals Manufacturing Barometer. This is put out by the American Chemistry Council. Now, this is an indicator for the U.S. as a whole, but so much of the nation's chemical capacity, it's concentrated in Houston. It's a good measure of what's going on with chemicals in Houston. And you can see chemical production in Houston from February to March, it's already fallen by about 7%. As we see a slowdown in the global economy, as we see a slowdown in manufacturing, chemicals and plastics are a big input to the manufacturing process. And if the US manufacturing slows down, if global manufacturing slows down, they're not going to need to purchase as many chemicals or plastics or refined products from us. So I expect we're going to continue to see weakness in the chemicals industry, at least for the next few months. This is US refinery capacity utilization. We've got about 20% of the nation's refining capacity here on the Gulf Coast, but this represents refining capacity for the US as a whole. It's very wiggly because you bring units down for maintenance, you bring them back up, you retrofit, you debottleneck and so forth. But generally, anytime refining capacity is above 90%, that's good for the industry. Then you can get by with 85, but when you're above 90%, you're doing well, you're making lots of money. Well, the concern is you can look on the right-hand side and you can see how far refining capacity has fallen. Refining capacity is just barely above 75% now. Refining capacity right now, actually utilization of refining capacity is actually lower now than it was in the immediate aftermath of Hurricane Harvey. Now, we're not driving anywhere. We're not driving to work. We're not taking public transit. We're not getting in planes and flying places. Trucking is actually slowed down, except that which is going to the grocery stores. So there's less of a need for gasoline, for diesel, for aviation fuels. And one of the concerns is our storage is beginning to fill up. And with the next couple of weeks, both our crude capacity and both our refined products capacity storage is going to be filled. And so the refineries are not running quite as full out as they would normally like to be because they just don't know what they're going to do with the product once they have no place to put it. Port of Houston, container traffic. This, we don't have full foreign trade data for the Port of Houston yet. There's a lag in that, but we do have data on the number of containers which are going through the port. And this is just looking at March going back the last 5 years. You can see every March we do a little bit better, we do a little bit better, we do a little bit better. Then whoa, look at March 2020. You can see the drop off in container traffic going through the Port of Houston as well. So that's a sign that we're starting to see a slowdown, that's both imports and exports. So it reflects both a slowdown on what's coming into the port and a slowdown on what we're able to ship out of the port. Commercial real estate. At the very bottom, you guys are going to notice the source line: Avison Young, Colliers, JLL, NAI, Transwestern. I just want to say thanks to these guys. I sent some emails out to a couple of brokers there asking for some insights. The problem is that all the data that they have and that I have as well is for the first quarter, so they're just now starting to see what's happening. So this is kind of based on anecdotes, what we're seeing. One of the things we're seeing a near halting in leasing activity for the last few weeks of March. Businesses are reluctant to take on new space. And if they can just get a 1 month, 2 month, or 3 month renewal on their lease, they're doing that because they don't know what the future is going to look like. The tenants are pretty much waiting on the sidelines to see how this shakes out. We're seeing a significant portion of the retail market not paying rents. And I need to explain, when you hear the retail market for commercial real estate is a little bit different than what you and I think about retail. When we say retail market, we're thinking of stores. And commercial real estate retail is going to include stores, but it's also going to include the restaurants and the strip centers. It'll include the nail salons. It'll include the barbershops. It'll include the boutiques. It'll include liquor stores. It'll include all the sort of different things that go in that neighborhood center that you will see. And so it's retail. It's not just the merchants that are having problem paying rents, but it's everybody in those centers. And if you drive by one of them during the middle of the day, as you go out maybe to pick up a hamburger, you just see how few cars are out front, how much business has slowed down. The uncertainty of rent, it's making lending difficult. There's still buildings that can be sold, properties that can be sold, but it's real hard to make up a pro forma to look at the financials when you don't know how much rent you're going to be collecting over the next few months. So you don't know what the revenue stream is going to be like. But the office and industrial lease seem to be less affected by the non-lease payments. So Houston Association of Realtors put out some data. This is data from March 2020 versus March 19. You can see the drop off in new listings. You can see the drop off in average listings. You can see the increase in the average list price. Part of the challenge is this reflects data for the entire month of March. And like everything else, the first half of March was actually pretty good. And then we started seeing the drop off the last half of March. And when we get the data for April, you'll see these numbers have dropped off even more significantly. You know, the part of the drop in listings is that people don't want strangers coming into their home. You know, they're pulling their houses off the market because in the concern about the outbreak of COVID-19, they don't want someone coming into their house, bringing the virus in, perhaps exposing the family. And similar, you're seeing traffic down because people who are worried about catching the virus don't want to go into some stranger's home and perhaps pick it up. And so I really expect that we're going to see listings fall more than this. There's a story out there that we're also starting to see, anecdotally, talking to some of the builders, we're actually starting to see traffic in the model homes drop off as well. Some of the builders expect they may put up maybe half as many as houses in 2020 as they put in 2019, but I'll try to get some more information on that for you for the next webinar that we do. We hear about the slowdown in air traffic. I think this illustrates it pretty dramatically. You can look here and you can see that in a typical day, the Transportation Safety Administration might handle 2.5 million passengers. This is all airports across the US, and you can look at that blue line and see how it slopes down, and they're barely handling 100,000 passengers. They're handling like 4% of what they normally handle, which just goes to illustrate just how much the airline industry is struggling right now. You want to see the impact on hotels? That's it here. These are hotels in Houston. Left-hand side is the upper-priced hotels. The right-hand side is the lower-priced hotels. You might kind of consider the upper-priced hotels be kind of the luxury class hotels. The lower price is more the general bread-and-butter sort of hotels. Occupancy down. This is a projection from CBR Hotels Advisory. They expect for the year occupancy to average 45% less than it did last year. They're looking at RevPAR. RevPAR stands for revenue per available room. It's a way to measure how much money is being made. The more rooms that you have booked, the higher your RevPAR is. It's a measure of sales, and you can see RevPAR is going to drop almost 60%. And the high end, you're going to see demand is going to drop almost 50%. You can look on the lower priced hotels on the right-hand side as well, and you can see the drop-offs that they're dealing with. Okay, so the Partnership does a survey once a week. If you're someone who receives the survey, thank you very much for filling it out. Asking questions of the members that have 500 or fewer employees, trying to get some sort of sense for what's going on with the small business community. We asked them the question, compared to 1 week ago, how would you describe your company's near-term outlook? If you can look, that red takes up an awful lot of that slice, that pie. Over half or about half of the firm said that their outlook, near-term outlook, is worse than it was the week before. Only very small slivers said they thought that it was a little bit better. We asked what actions are they taking to combat COVID-19. You can see the number that instituted work from home practices, the hiring freezes, those have shut down whole or partial operations, the layoffs, and so forth. The biggest concerns during the pandemic, part of it is just sales. If you're not generating sales, then you have a real question about your own survivability. You've got to generate sales, you've got to bring in revenue to pay those employees, to pay that rent. Next to that is employee well-being. You can see the impact on profits and so forth. We had about 10 different responses down, but we only put the responses where we got 10% or more, checked it off. They were allowed to check any and all that apply. So economic vitality. The question, based on the current cash flow projections and without federal assistance, how long can your business stay afloat? There are some businesses out there that won't be able to stay afloat more than three to 4 weeks. And this is the survey that was done last week. So you could even say that's 2 to 3 weeks. But it's interesting, if you looked at it, the vast majority of them say they think they can get by 3 months or longer. Now, let's really hope it doesn't go 3 months or longer. But there are those out there that figure they might be able to make it 3 months or longer based on the current cash flow projections. Part of it's just cutting back operations to the bone, and part of it's probably not paying rent and just trying to cut all sorts of expenses out so they can manage on their own cash flow. The other question, when do you expect to resume normal operations in Houston? This once again survey of small business members. I don't know how much of this was realistic or wishful thinking. There were a small number that said they hope they'd be back to work in a week or two. But if you look at this once again, the majority think it's going to take 7 to 8 weeks before we resume normal operations in Houston. Now the question comes down is, what do we consider normal? We didn't define that in the question. As we talk about going back to work, there really isn't a plan just yet. We're talking about all sorts of things I'll touch on a little bit, but we're not sure what normal will look like and how soon we will be able to get back to work at this point. So if you see something that looks like this is that survey I mentioned earlier. We're sending this out to members of the small business community. If you get this, would you please, please, please respond to the survey? This is the way we're trying to get the most timely data possible about what's going on in the business community. Because like I said, there are lots of lags in the data. We're still working with data from March, and part of the problem with March is that the first half of March was pretty good, the second half was pretty lousy, so we're not getting a true picture of what the economy looks like right now, but we can get a truer picture or some inkling if we have more people respond to the survey. Now, I haven't talked about employment at all, other than the reference I made to the initial claims for unemployment insurance. And this is the reason why. This is the schedule the Texas Workforce Commission puts out, and it shows you when we're going to get the employment report for April. Because like I said, March, first half of March was pretty good, the second half of March was pretty lousy. And the way the Texas Workforce Commission collects the data, they're going to be looking at the number of people on payroll the first half of March. And so even when we get the March numbers at the end of this week on April 17th, it's probably not going to be a good representation of job losses. But when we get the April numbers, we will have a pretty good idea of how many people lost their jobs. But we're not going to get that till May 22nd. We're not going to get that for 4 or 5 weeks from now. By then, hopefully, we may all be back at work, or we'll see people returning to work. So it's definitely a lagging indicator. But when it does come out, I will report on it for you guys. Let's talk about oil. That's the other big issue. The other big challenge Houston's facing right now is we're getting ready to see, once again, another collapse in oil prices, once again, another downturn in the oil and gas industry. Some of you have heard me say this is, I've been studying this economy 35, 36, 37 years. I'm losing track. This is either my 5th or my 6th, maybe my 7th downturn I've seen in the oil and gas industry. And before I retire, I know I'll probably see at least one more, if not 2 more. So the headline in the Wall Street Journal Monday morning, actually it was Sunday evening, was U.S., Saudi Arabia, Russia lead the pack for record cuts. And then less than 24 hours later, U.S. crude falls with supply cuts inadequate to cut the glut. And the issue is that they've cut, but they haven't cut enough. The world consumes, prior to COVID-19, the world was consuming close to 100 million barrels a day of crude. I'll repeat that. We were consuming close to 100 million barrels a day of crude. And what we're seeing is with the collapse in demand, that we're only going to need about 75 million barrels a day of crude going forward for the next few weeks. In essence, we've got 25 million barrels a day overhang. And all we've agreed to cut is about 10 million barrels. And so the markets are responding, saying that's not enough. Eventually, we're going to start to see some production fall off, some production shut in, but we're not going to see prices get up until we start to see production become more in line with demand. First bullet, if you look at that, prices closed on April 13th at $22.72 a barrel. That was Monday. If you look at where we were back during the worst downturn for the oil and gas industry in history, that was in 1986. Crude closed that day at $12.94. If you adjust the 1986 close for inflation, that would be $30.76 today. In essence, we're seeing crude trading lower now in real terms than it traded for back in the worst part of the oil and bust. That gives you some idea of just how bad it is. This is a survey the Federal Reserve Bank of Dallas puts out, asking about the areas in which firms are active. What do they need to cover the operating expenses for their wells? This isn't finding costs. This is just the well's been drilled, it's producing, but you have to put money into the well to keep it producing. And this is the operating cost, 23, 26, so forth. And you can see that at the current price that they can get for crude, it's not even covering operating costs. For some of these firms, every barrel of oil they produce, they're losing money. So what you're probably going to see is some firms shut in production, so they can shut it in and not harm the formation, and shut it in and wait until oil prices get back up and produce it later at a higher price. But if you shut in production, then you're not going to be doing all the servicing on the wells, which is going to affect the oilfield service firms and the people employed by them. This is a Federal Reserve survey asking a different question. What firm do you need? What price do you need to profitably drill a well? And you can see 46, 50, 51. So you're looking around $49, $50 a barrel to drill a well. We're not even at half that price. And so you're going to start to see exploration continue to drop off. The last time I checked, the rig count was down around 600 rigs. It's not been above 1,000 rigs for quite a few months. I wouldn't be surprised to see the rig count drop to where it was at the lowest part of the fracking bust. Lowest part of the fracking bust, it was 404 rigs. I wouldn't be surprised in the next few weeks that we see the rig count drop back down to 400 rigs again. Another question from the Fed survey, and if the WTI price of oil were to fall to $40 a barrel, and we know it's fallen below $40 a barrel, how long would you expect your firm to remain solvent? You can look at 15% of the firms out there won't remain solvent at the current price of crude. They'll go out of business this year. There's another 25% that said they may be able to last a year or two. But once again, this question was asked for oil at $40 per barrel. And it's at half that price now. We're likely going to see some more bankruptcies in the oil and gas industry. Or you're going to see companies simply shut down. You're going to see companies struggle. We are going to see some layoffs, but we're not going to see layoffs not quite to the extent that I thought we were a couple of weeks ago, because as I'm getting some reports out there, companies are worried that if they let their workers go now, they'll never get them back. And so what you're seeing is some furloughs, or you're seeing some cuts in pay, hoping the companies, the employees will stay with their company and try to get by until they can be pulled back to 100% normal pay, or pull back to working a normal 40-hour a week or normal however many hours they work during a week. So we are going to see some layoffs, but I don't think we're going to see quite as many layoffs as I thought we'd have seen a few weeks ago. So Reuters study, Fed's capital sees U.S. growth returning in the second half, but consumers are staying cautious. And so, yes, I do think consumers are staying cautious. Part of it is, and in one sense, there's this worry about the second wave, the second epidemic. There's this concern about personal finances. If you had any money in the stock market, you've definitely seen a hit. If you're living off your 401k, or if you were close to retirement, you're going to be worried about what's happening with your 401k. So you're going to be pulling back some spending there. So this is going back to that survey of Wall Street Journal economists asking when did they expect the recovery to begin. And you can see the majority expect the recovery to begin either in the third quarter or the fourth quarter of this year. So pretty much by the fourth quarter, based on, if you believe kind of in the wisdom of crowds, if you believe this big group of economists, by the time we get around to October, November, December, they're hoping that we will be in recovery, the majority of the economists out there. And for the U.S. as a whole, I don't disagree with that. I am still kind of concerned about Houston with the weakness in oil and gas prices, how that's going to add an extra weight on our economy. This is McKinsey and Company survey that they've done asking U.S. consumers how long before their routines return to normal. And you can see that some of them, a third of the respondents say it's going to take at least 4 months before their routines return to normal. Another third says it'll take 2 to 3 months. So this kind of underscores what I've been saying, that consumers are going to be a little reluctant to go out and suddenly start spending. It may be a little bit, there may be a little bit of the post-hurricane effect that we're all going to want to be able to finally go out and eat out. But I don't know how many meals eating out that we can do in a week. There'll be some pickup, but probably not enough to make up for all the pent-up demand out there, all that's been lost the last few weeks. You can see here, once again, the survey of the Wall Street journalists, the numbers expect we might have a V-shaped recovery, or the ones who might have a prolonged U-shaped recovery. And so there's this debate out there. Is it going to be a V-shaped? Is it going to be a U-shaped? Is it going to be a long recovery? the problem is there's so much unknown out there that and I sound like a broken record for those of you who remember what records are. Maybe I'm repeating myself over and over again, but there's still so much unknowns out there, so much uncertainty, still some anxiety out there. We're not really sure what the recovery is going to look like, but you can see that McKinsey actually has 9 different scenarios for a recovery, and depending upon whether the virus is contained or whether there's a recurrence, how strong the rebound is, and so forth. So you've got the Wall Street Journal economists thinking there are 4 different scenarios. You've got McKinsey thinking there are 9 different scenarios. I don't think it's going to be a V-shaped recovery, and I'm hoping it's not a U-shaped recovery. Here I am, I'm hedging my bets again. But I really don't think it's going to be a V-shaped recovery. I think it's going to be a while before people become a little bit more comfortable with their spending money, and businesses are going to be waiting a little bit longer before they start hiring and making those investments to make sure there's not a recurrence. So with that, there's a lot of dialogue out there about when are we going to return to normal? When are we all going to get back to work? When are we going to open the shops back up? Well, it's not going to be like flipping a light switch. There still needs to be some widespread testing out there so we have a better understanding of just how prevalent it is. We'll need to start doing contact tracing again. We've been lucky in Houston that we've yet to exceed our healthcare capacity. I think we've done such a good job of social distancing and working at home and staying safe that we haven't quite got there yet. Hopefully we won't. There needs to be an effective vaccine, and there is concern about their possible resurgence in the fall. So not quite sure what the return to work is going to look like. As I said, there are lots of debates going on, trying to understand what it should look like. But if you're like me, I'm ready to get back to work. I'm ready to see my friends at work. I'm ready to get back into a routine. You do notice I did put on a shirt with a collar today to do this. And gosh, I'm actually looking forward to maybe putting on a tie as well. So with that, just one final thing. You're probably looking, who's that old guy on the screen? Not me, not this old guy. The old guy on the left. That's Robert Baden-Powell. He was the founder of the Boy Scouts, and he had a motto that he tried to instill in all the Boy Scouts. Yes, I was a Boy Scout. He said, be prepared. And someone once asked him, well, Sir Baden-Powell, what should we be prepared for? And he said, just about anything. That's kind of where we should be right now. We should be prepared that maybe this coronavirus will dissipate and we can get about with our lives as normal, or it may be something that gets stretched out. We may have a second pandemic. I don't know. But my best advice for you out there is be prepared for the fact that there's still a lot of uncertainty. We don't know how this is going to play out. And you should just hold your cards close and be prepared for whatever may happen. So with that, thank you very much. I appreciate your time. For those of you who did tune in earlier, I apologize for some of the technical challenges we had. I've got an IT working on it. I've actually got an email from my internet service provider, which I'm going to respond to when I'm done with this. And hopefully we'll have this, so the next time we do a webinar like this, we won't have the same sort of challenges. So thank you very much. I hope everyone is healthy and safe, and I'm looking forward to seeing everybody back in the partnership offices and at partnership events, hopefully not too far in the future. Thank you.
Hey.
Okay, Shireen, how was that?
I think it was